Now, the granting of credit in business is a standard practice designed to be able to attract more customers. Ideally, any business would love to be able to sell on a cash basis because there are two advantages. One, collects the cash immediately, which is great from a time value point of view. Secondly, one doesn't have to have in place systems and people to follow up and chase the settlement of accounts receivable with clients. However, granting credit is a necessary part of being able to be competitive, and therefore many companies, if they're not in the supermarket business or the fast food business, restaurant business, for example, will find themselves having to assess the creditworthiness of customers in order to determine whether or not they can give a particular potential client credit or not. Now, the assessing of creditworthiness, we borrow from the banking sector the traditional 3 C's of credit, which have been since expanded to 5 C's. These are considered to be time-tested and therefore a very useful way to approach the issue of credit. Now, the 5 C's consist of, and we'll take them in turn. One is character. Now, character has to do principally with the reputation of the principals or the counterparty, the person with whom one is doing business. It's got to do with the obligation that the borrower feels that they have to pay their obligation, so that even if there's an ability to pay, the question is whether they feel committed to making the payment. So this is connected to honesty and things like that. So it's a very kind of abstract notion and difficult to determine, except of course looking at references on the company and to see whether what their track record is in terms of reliability of meeting payments. Okay, next we have capacity, and this capacity is connected with the ability. Now, this is more a technical point, the ability of the company to meet their obligations, to be able to generate the cash necessary to pay what's due. So this, of course, is a financial analysis kind of approach to assessing creditworthiness, in which the financial statements of the company would need to be examined. Next is capital. Capital refers to basically the amount of money that the client has invested in their business. It is an indication of how much they have at risk if their business fails, and also the ability of the client to be able to withstand financial setbacks. Okay, so this is a question of, it's really two-pronged. One is financial staying power, and especially in hard times, their ability to maintain the business and survive. And secondly, the fact that they have really something to lose by entering into a business transaction with oneself. It shows, it's an indication then of commitment to make sure that the transaction will succeed. Okay, so those are the classic original 3 C's of credit. Then over time, a fourth has been added, collateral. This is connected with what kind of security can a lender or a provider of credit obtain from a client in order to further protect themselves against default. So we could talk about this as being any sort of credit risk mitigation. It can be some form of collateral which is provided, or charge over assets, or a lien on some value, or it could be a third-party guarantee which is provided in order to make the extension of credit safer. And finally, conditions. Conditions are actually two-pronged here. One is clearly the understanding how the evolution of the general business environment will affect the customer. And the other aspect with regard to conditions can be seen, some people look at this in a slightly narrower context, the structure of the contemplated transaction. The structure is appropriate to the objectives of the transaction, that the structure is appropriately crafted. But of course this is concerning more typically different types of bank lending to a customer. Clearly, the granting of credit by commercial firms will be usually 30, 60 or 90-day credit extensions, simple deferred payment in which there's not a great deal of structuring that needs to be done, except possibly for considering what kinds of collateral can be obtained to secure one's interest. Okay, moving along here now, to grant credit to customers, that's typically the job of the credit manager, and the credit manager of course has to review relevant information about the company to which credit extension has been proposed. Now, there's generically two general sources of information. One is one's own experience as a company with a particular client. If the client's been buying on a cash basis and reliably paying for over a period of time, so based on the company's own experience, they learn about the client through direct contact. That can be considered to be own internal experience. External experience is, of course, going to be something which is done through credit checkings with bureaus, credit agencies, perhaps with banks, or trade references in the industry. This is considered external. Both sources have to be taken into consideration and weighed. Now, one way in which a company can get to its cash more quickly is to grant settlement discounts to customers. In other words, if they settle their invoice earlier by a certain deadline, that they would qualify for a reduction in the amount of the invoice that they have to pay. This is a financial incentive, and of course it's up to the company granting such early settlement discounts to make sure that the benefits are greater than the costs of providing such a benefit. In other words, it's a cost-benefit analysis. In other words, the costs typically will be the amount of the discount itself which is granted, and therefore the company has to be sure that the benefits, the financial benefits of receiving the cash more quickly, that these benefits will be greater than the cost of the discount which they are asked to give up. If that's not the case, and if the discount turns out to be more costly than the benefits, then of course granting an early settlement discount is an exercise in value destruction, if you will, and actually is worse. The company would be worse off doing it. So there has to be a very systematic approach to being able to evaluate the amount and terms of early settlement discounts.